The pound hits a one-year high against the dollar after inflation fails to ease in June. Welcome to Market Insight, I'm Ramzan Karamali. Well, British CPI defied forecasts and held steady at 2% in June, with services inflation holding at 5.7%. Well, after the release of the data, investors also reduced their bets that the Bank of England will cut interest rates in 2 weeks' time for the first time since 2020. But were they right to do so? Well, to help answer that and more, I'm joined by Francesco Pesole, FX strategist at ING. Francesco, thanks so much for joining us. So is an August rate cut now off the table, even though inflation is at the bank's 2% target?
I wouldn't say it's off the table, but it's understandable that markets are pricing out to a certain degree the chances of a rate cut in August. We know that the Bank of England is extremely focused on services inflation that's held steady at still pretty high levels. We think probably a Bank of England cut in August is as close to 50-50 as it can be now, but we'll need to see probably jobs data later this week to get a clearer picture.
And what did you make of the reaction in the currency markets to today's data? I mean, the pound hit a one-year high against the dollar, it hit a two-year high against the euro.
Well, the initial reaction in the pound from CPI data was not huge. Obviously, the pound traded higher, which is understandable given the repricing in rate expectations for the August cut. However, it did hit the 130 level on the back of a broad-based dollar decline, which appears to be mostly driven by the yen more than anything going on in European FX markets.
Well, you bring in the yen there, and it's not been a good day for the dollar against the Japanese yen, as you say. The yen rose sharply on suspicion there's been intervention by Japanese authorities. What do you make of the situation there?
So we've seen a lot of volatility in dollar yen lately because, as you mentioned, it's very likely that the Ministry of Finance of Japan have intervened over the past week or so in the FX market to support the yen. Now, we must remember that there isn't much transparency when it comes to FX intervention until month-end data are released. And this means that markets are kept guessing on whether and how those interventions are being carried out. And I think the big move today does flag risk that there was indeed another round of FX intervention. However, it also appears to be a consequence of some comments by Donald Trump that he wishes to see a weaker dollar, and particularly looking at the 2 week, in his opinion, Asian currency. So that appears to have been the initial trigger for the move today.
Well, on those Trump comments, he's right, though, in some respects, isn't he? The dollar has been pretty strong against most currencies this year. Do you see a general weakening of the dollar going forward?
I think that the macroeconomic basis for a weaker dollar are definitely there. That's because the US economy is losing steam, the US jobs market is losing steam, and we're seeing some disinflation that would be consistent with rate cuts by the Fed, so a weaker dollar. At the same time, what is actually keeping the dollar up is the threat of new protectionist measures in a potential re-election of President Trump. So there would be obviously something we need to weigh in the coming months, because markets appear to be making a conviction call on the US election at the moment. So despite Trump not liking a strong dollar in a way, many of his measures back in his first presidency, and this could be the case again if he gets re-elected, do support the dollar. So it's a bit of a dichotomy going on there.
Well, tomorrow all eyes will be on the ECB. Are you with the majority and not expecting another rate cut there?
Yeah, absolutely. We don't expect a rate cut, and actually we don't expect much at all in terms of new sort of communication of forward guidance by the ECB. We think they are looking at a very mixed bag when it comes to macroeconomic data. So inflation is not moving to the downside as fast as they would have liked, and also there are concerns about sticky wage growth. But at the same time, we know that the ECB, like most other central banks, are influenced by what happens in the US. And the repricing on the dovish side of Fed rate expectations means that there is some pressure also on ECB rate expectations to move lower. And of course, we have French political uncertainty and all the turmoil we're seeing in the bond market. So we think at this stage, given that almost surely they won't cut rates according to recent communication, then they probably have a lot of interest to avoid giving any new guidance to markets and prevent any big volatility in markets after the announcement.
Francesco Pesole from ING, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.